All right, today we are talking about why now is an amazing time to invest in new startup companies, especially companies that are reducing friction and making manual processes work at scale a lot easier than it used to be. My guest today is Martin Tobias. He's a venture capitalist based in Seattle, investing in cutting-edge technologies and startups. I'll tell you more about him in a moment, so stay tuned.
Welcome to the Smart Business Revolution podcast, where we feature top entrepreneurs, business leaders, and thought leaders and ask them how they built key relationships to get where they are today. Now, let's get started with the show.
All right, welcome everyone. John Corcoran here. I'm the host of this show. And if you've listened before, you've heard some of my previous episodes, but I definitely want to point you to some of my past episodes with CEOs and founders of Netflix and Kinko's and YPO, EO, Activation Blizzard. We've got all kinds of good episodes in the archive, so check them out. And of course, before we get started, this episode brought to you by Rise25, my company where we help B2B businesses to get clients, referrals, and strategic partnerships with Done For You podcast and content marketing. You can learn more about what we do at rise25.com. And as I mentioned, my guest is Martin Tobias. He's the founder of Incisive Ventures. It's a venture capital firm based in Seattle. They focus on investing in technology companies that reduce friction at scale, and we'll explain what that means in a moment. He's got 25 plus years experience in the technology world, from Microsoft to smaller companies. He's invested in literally hundreds of different companies, including just in the last 4 years, 4 different unicorns. We'll ask him about that as well. And I'm really excited to talk to him because of that background, especially right now, because we're recording this in mid-2023 at a time when it's kind of a strange economy. And we'll get to that in a second. But, Martin, I told you beforehand that I love to ask people about their entrepreneurial ventures as a kid. And you grew up in Gainesville, Florida, not too far from University of Florida Gators. Your house actually was right near the parking lot where people would go to the game. And you, young little 6-year-old Martin, saw these throngs of thirsty people in the hot Florida sun walking by your house, and you thought, there's a business opportunity. Tell us about it.
Absolutely. Hi, and thanks for having me. Yeah, when I was young, we weren't that rich, and there was, as many kids do, lots of things that I wanted in life, and I wanted, like nothing else, this round radio. It was an AM radio. It looked like the Star Wars Death Star, and it had like a keychain on it. And I was obsessed with this thing. It cost like $40. My parents said, we can't afford it. So I said, well, what can I do? And they said, well, you have to earn money. And when they told me that on a Saturday, and the next Sunday, I saw all these people walking to the game, and I was like, there's an opportunity. So when you have a need and it meets an opportunity, I'm like, okay, what can I do here? And I started a Kool-Aid stand, and every Sunday that summer or that fall during the football season, I would sit out there, and I made enough to buy like 10 radios. And that really got me interested in entrepreneurship and, being able to do work that, helps you achieve the goals that you want in life. And, that was a powerful lesson to learn very early. And something I try to pass on to my kids is, the value of money and the value of earning your own money and then deciding what to do with it. So I don't know if you have kids, but my kids, when we go to the store, they're always begging me for something, and I give them an allowance, and I tell them they have their own money. And if it's important enough, they can spend their own money. And so they have to learn about the trade-off between, do I want the money or do I want the thing that I want?
Yeah. And I do have kids, and we've done lemonade stands a number of times, and such an important lesson, placement of that lemonade stand. Every time I drive by some kids on a corner on a quiet street doing a lemonade stand, I'm just like, oh, guys, like go next to the park during concert in the park or something like that. It's going to work so much better. You have to work, a fraction as hard, and you make great money. So, so you learn those lessons about entrepreneurship, and you end up studying your double major in business and computer science, and impeccable timing, because just as we're moving into this really inflection point in technology, and that's kind of was your early days of pursuing entrepreneurship. Talk a little bit about what inspired that.
Yeah, absolutely. So, I was really interested in computers, and frankly, I'll date myself a little bit, but my first computer programming class I actually did on a DEC VAX, and we had a card reader, and you had to stack your cards, and if you dropped your cards, your program had. That's what they called when they called a bug. Bugs are actual bugs in stacks of paper that they used to have. But very soon we got Macintoshes. But I was always interested in solving business problems with computers. There were lots of my friends that were very interested in the core technical problems. At the time, people were writing like device drivers for keyboards and stuff like that. And that's fine. But I was always like, how can we take this technology and apply it to a business problem? So in college, my computer programs were things like stock trading algorithms and things like that. And I started a business in college. I hated going to class, so I paid people to go to class for me and take notes, and then I sold those notes to other students. And I was CFO of the student government and helped us increase revenue and that sort of thing. So I was always interested in technology, but that intersection of technology and business, as opposed to the purely technical problems, and that continues to this day. My thesis in investing is technology that reduces friction. Why reduce friction? Because then you've got more time to do something else that you might want to do with your life. And I can go through some examples of things that I've invested in, but that's been a powerful force for technology, from the beginning.
I definitely want to get to that. I want to ask about Loudeye Technologies, formerly in coding. Now, you had done a stint at Anderson Consulting and then Microsoft. And then you saw an opening. This is 96, 97, very early days of the internet, but you kind of had a vision that digital audio and video would become a lot more commonplace than they were, at least in the early days of the internet.
Sure, certainly. And if you remember back then in 96 and 97, that was before every PC came with a sound card and, speakers and stuff like that. You had to buy those things separate. Those were accessories. But my bet was that, audio and video, playing, recording, production, everything would be a core part of what people did on PCs, as opposed to at the time, people were basically using them for business productivity, word processing, spreadsheets, databases, right? Not a lot of entertainment. But I'm like, hey, that's going to get sucked into the core PC. It's all going to be free, and people are going to want to experience that content. So what's the opportunity? Well, the problem was that the entire content libraries in the world were sitting on formats that were not compatible with the PC. They were sitting on VHS tapes, beta tapes, CD-ROMs, things like that. They were not accessible. So I said, well, what would bridge that gap? Well, a service provider, somebody that has the technology to convert this into that. And so we built the world's largest transcoding facility in Seattle, and we had deals with all the major labels, and they would ship us truckloads of CDs, and we would rip them and convert them into digital
servers. Technology, basically.
Yeah,
right?
And then we could push a button and convert that to Windows Media or MP3 or the different various digital formats that were still competing for standards at that time. And I said, there's going to be lots of standards. There's lots of content that's not in the right format. I can create a business being a middleman, an enabler, and an on-ramp from traditional media to digital media. And that was the timing of that was pretty good for that.
I want to ask about that, the timing of it, because there can be advantages to being a early adopter, a first mover, but disadvantages to being too early.
Yeah.
Looking back on it now, do you think your timing was it the right time to have that type of business?
My timing was right because we were sort of speeding that transition along, and it was very, very expensive and very hard to do at the time. I tell people, I bought in 1999, I bought a 300 terabyte RAID array. I paid $100,000 a terabyte.
Wow.
In 1999.
Yeah.
So this was an incredibly capital intensive. This job was not going to get done unless somebody raised a giant amount of venture capital or went public like I did and did it. I mean, literally, we would not have had it. Now, you wouldn't want to have a company like that today because the cost of running that company is almost nothing. And by the way, the rights owners, like the labels and the studios, already have digital masters and can just do it themselves. So for the time, it was the right thing. We were definitely early, but the industry needed a player to help make that transition. So yeah,
tell me about this is an
interesting
time period, because we're talking 97 to 2000. You actually go public. You're actually the last real .com company to go public before the crash around March of 2000, I think, was kind of the peak. What was that experience like?
Well, it's better to be the last than the one after the last. So we went public on March 17th of 2000. The peak of the NASDAQ was March 21st. 4 days later, we were able to raise $120 million in our IPO for a company with $10 million of revenue, got a $2 billion market cap. It's better to be, if there is a bubble, it's better to be in the bubble than outside the bubble. So there's,
let me title your next book.
we were lucky.
There's a bubble, be in the bubble.
Be in the bubble, not out the bubble. I mean, I can't tell you how many, of my friends in crypto are, complaining that they didn't sell last year. Every time a bubble bursts, you are wishing you had sold when the bubble was full. And the bubble was pretty obvious, but it also, while some of the marginal companies didn't make it, there were some very transformative companies that were started and made it through the bubble. Companies like Amazon and eBay and PayPal. And, being a capitalist, I am very much in favor of the all boats rising strategy. And, after bubbles burst, people can go around and go, oh, that was stupid. You should have never funded pets.com. Well, okay, maybe pets.com shouldn't have been funded, but then Amazon wouldn't have been funded either. So, and we just finished basically in November of last year, another 12-year bull run in venture capital where you had ZERP and basically free money. And we had an incredibly positive time for starting companies because there was lots of money around and it was basically free. And now we're going into a different cycle, which I've seen before, and it's going to be a little harder to start companies. There's going to be fewer innovations that get funded, but we will come back to a more permissive environment. I actually think there's some good things about the environment we're in now. Actually, if you look at the companies that were started in 2001, 2, and 3 after the crash, some pretty amazing companies were started after the crash because you have to operate very differently when money is a constraining resource than you would operate when money is free.
Yeah, for sure. So during that period of time, Loudeye, 97 to 2000, you went from 3 people to 450 employees.
Yeah.
What were
I would not recommend that to anybody. 3 years from start to IPO is really too fast.
Yeah.
The standard thing is 5 to 7 years.
Looking back on it, what were the biggest peaks and valleys, the biggest highs and lows of that experience, that period of chapter in your life?
Well, the highs were that we were in this hot category and everybody's throwing money at us at crazy valuations, and also our customers, loved us. We couldn't do the work fast enough. Everything was great, until they turned off the spigot, and then everything was not great. But that's part of it. You can't take the highs if you're not willing to take the lows. Probably the biggest mistake that I did in that was basically, I like the beginning phases of companies. I don't like running big companies. And I told the board that after the IPO, I wanted to be chairman and hire a CEO, this sort of professional management thing. And, I didn't want to have 450 employees. It's too many employees. So I did that. Unfortunately, the market had changed radically. And, the CEO who replaced me didn't have the same grittiness that I would have, and ended up, blowing the $120 million and 98% of the stock price in like a year and a half.
Oof.
And if I had been running it, I think I would have done things differently. I would have reacted differently to the down market. But I think handing over your baby to somebody else, especially if the macro environment has changed materially, I would not do that again.
You one of your later stops was you were chairman and CEO of Imperium Renewables.
Yeah, and CEO. Yeah. Mm-hmm.
Yeah, tell us about that.
So basically, my foray into renewable fuels, I was, after Loudeye, I was at Ignition for a while doing investing. So I've sort of gone back and forth between entrepreneur, investor. I'm back in the investor seat now. And I was investing at Ignition, and we did a bunch of enterprise software deals, and they were sort of tripling down on the enterprise, anything Microsoft or Cisco might buy. And frankly, I thought the enterprise was a big yawn. It wasn't that exciting. And I got interested in renewable fuels and clean energy and stuff like that. And I looked at the trends of, peak oil and oil prices and stuff like that. And I'm like, I think there's something there. And by the way, not a lot of people who come from technology have gone into that industry. And if you rethink that industry, like some people at technology might have, maybe there's some interesting opportunities there. So I started talking to companies. I started an angel group called Element 8 Angels, which is still going on in Seattle. They've deployed about $50 million to clean tech companies. But I started investing in companies, pitching, and da-da-da-da-da. And anyway, I met this guy, John Plaza, who was running Imperium Renewables. And his idea was to build a scale of a biodiesel refinery that could convert palm oil into diesel. And if at the time, if you had done a 20-year back test in terms of commodity correlation between food grade oils and diesel, there was no correlation because these were two different markets. But you could make a machine that would convert those two, and the margins in oil were much higher. Then the question was, how much does it cost to build one of those machines? And the old way to build a refinery is a very custom one-off engineering approach, basically like old enterprise software, like IBM developing software. You hire a bunch of consultants, you come in, you spend a bunch of money, you take 5 years and you build something that's really expensive, but it works exactly the way you want it. And I looked at that and I said, is there a way to build this thing like they built PCs?
Kind of more of a software approach to a hardware
like a software
problem.
approach. Yeah. Could you take commodity parts from other industries and screw them together as opposed to custom manufacturing every pump and every valve and every blah, blah, blah. And we looked at how you would design a refinery using commodity parts instead of custom engineered parts. And it turns out you could build a refinery for about 1/20th the cost if you used off-the-shelf parts. So we said, let's go build a refinery using basically the PC model as opposed to the mainframe model. And that was my insight that I brought to the refinery business. We built the world's largest biodiesel refinery. We, did very well, made a couple $100 million in revenue, and had that company on file to go public in March of 2000. Unfortunately, with that one, we missed the IPO window. The IPO window closed on us before we were able to get final SEC approval. So in that one, we were definitely one of the darlings of that wave of clean tech. And then the 2008 crisis closed before we were able to get it public.
You said March of 2000. I think you meant 2008, maybe March.
Oh, this is for Imperium.
For Imperium, yeah.
In 2008.
Yeah. That's interesting because you've done a lot of software before, the very different type of challenges. And I just finished reading Ashley Vance's great new book that's kind of about all these different space companies, rocket companies, satellite companies that are part of this larger trend of using more off-the-shelf technologies in order to build things at scale much cheaper, faster.
You see more people doing it now in industrial settings.
Yeah.
And I think I was one of the first to bring that idea, to a large industrial project like a refinery. And you have seen some interesting technology people going into traditional manufacturing industries. I mean, I won't tell you I'm as smart as Elon Musk, but that's Elon Musk's approach, right?
Yeah, for sure. Yeah, definitely.
PayPal to cars.
Yeah, right. Yeah.
But he rethought fundamentally how you build a car from first principles. And I rethought how you build a refinery from first principles. And other people in the industry, they simply didn't do that.
Yeah, and there's a lot of other companies that are now
And
embracing
in
that
space,
approach.
people are rethinking space. He did that with SpaceX, right?
Yeah, yeah,
Rethought everything from first principles, which is very much a software engineer type approach. And when applied to another industry, it can be successful.
Yeah, and Rocket Lab and a bunch of other companies are doing this as well. But I want to flash forward to present day. So as I said, we're recording this in middle summer of 2023. There's a lot of doom and gloom right now. There's a lot of kind of pessimism in the economy. But as you pointed out, some of the biggest companies out there, LinkedIn, Facebook, Google, stuff like that have launched in downturns.
Yep.
And another thing is that a lot of people that are getting laid off by these larger companies are even starting companies right now. So talk a little bit about what you're observing in the marketplace right now.
Yeah. I've been through 3 or 4 major corrections: the 2000 crash, the 2008 crash, the 2020 crash. And the interesting thing is that company formations always explode after that. To your point, ZDNet did a study a couple of weeks ago. They interviewed a bunch of people that had been laid off from Microsoft and Google and Twitter. 63% of them said they're going to start a company. And, that's a huge number. So company formation goes up. And also every year, the cost of starting a company goes down. And this year we have something that is a little bit unique, a new step function improvement in productivity. And that's all this AI stuff. AI co-pilots for developers and stuff like that. But the wave that really kicked this off was like cloud computing. The minute you could start your business and just buy cloud resources instead of having to set up a data center at Equinox yourself, the time to market for a new startup went down by this, right? Mm-hmm. So the cost and time keeps getting compressed. It's actually interesting. I did a post about this on my blog called The Great Asset Repricing. And if you look at the time to recovery of startup funding after every crash, in 2000, it was approximately 3 years before the stock market returned and VC funding returned. In 2008, it was approximately 1.5 years. In 2020, it was approximately 3 months. And so in every correction, the time to recovery is shorter than people think. And there's more money out there than ever looking for investments. So more people available, cost of starting a company cheaper, valuations have corrected a little bit, which is actually better for investors to invest more money. Frankly, if you look at the venture returns of venture capital firms that were started in different years, the venture capital firms that started deploying their money after a correction, 2001, 2, and 3, 2009, so on like that, tend to be very well-performing venture capital firms. And I believe that's going to be the case for venture capital firms that were started in late 2022, 2023, 2024, because great companies are going to get created. I'm most excited about the benefits of AI because basically in every company I've ever funded, the constraining resource is development capacity and time to. Every startup that I've ever invested in has more that they want to build and not enough engineers. And with some of these AI co-pilots like GitHub Copilot and this and that, you can take a standard engineer and make them a 10x engineer. You can basically code shit faster. So all these people that are gloom and dooming about, AI is going to take our jobs, I don't believe it. It's just going to help us get more fucking shit done. Sorry, I don't know if I can say that on your podcast.
Quite all right.
But
quite all right.
The problem is dev ticket backlog. And these things help you do faster. So, let's say I give a company $1 million, they can probably get 2 or 3 times done with that $1 million than they could have even 2 years ago. So my money goes farther, they get farther into the market, they get more features written than they would have before. That's a huge accelerant for innovation. Now, the question is still, are you building the right thing? Will customers pay for it? But you can build what you want to build cheaper and faster than ever, which is great for innovation.
So your thesis is this idea of reducing friction, looking for ways in which
at scale.
At scale.
So I came up with this basic idea. when the pandemic started, I looked at all the 200 companies I'd ever invested in, and I tried to figure out which ones had done the best and what was similar about them. And they all had this idea that they were software technology that was reducing friction and scale. And, one of the perfect examples of that is when I was a venture partner at Ignition Partners. Ignition led the Series A of DocuSign. And if you think of what DocuSign was doing, signing things on your phone instead of a fax machine. So it's technology that actually, replaces a manual process. And there's millions of signatures a day. There's the scale, right?
Yeah.
So then the big question of DocuSign was, is this a feature or is this a company? Because it looked in the beginning, frankly, it was hard to raise money for the company because it looked like, Adobe could write this in 5 minutes and, it looks like a feature. But what they were able to do is to create the signing order and the email and integrate with workflow, with document management systems for real estate and things like that, so that it became a brand and a platform instead of a feature.
Right.
And
where a platform never existed before because it was a combination of different things.
Before.
Right. Yeah.
Exactly.
Yeah.
Look at another one. I was not an investor, but something like Uber, right? How big was the rideshare market before Uber? Zero.
Right. Yeah.
Right. But the friction was that you'd call a phone and you'd talk to a dispatcher and he'd radio to a bunch of people and try to find you. I mean, it was friction.
Horrible. Or you stand in the rain on a corner trying to
stand in the rain, waving at
by.
somebody, right? Yeah. Now you push a button, 5 minutes later, there's somebody there.
Yep. Yeah. And here in San Francisco, there are driverless cars driving around with literally driverless cars driving around now.
Exactly.
Today.
So I read a study once that the number of people taking, rides, including taxi, is something like 20x more than it was when we only had taxis. Here, there was a latent demand for people mobility that nobody knew because the system we had for mobility was so inefficient that it constrained the demand.
Yeah. Yeah. I remember after Uber had been around for a couple of years, I went on vacation to Hawaii where for some reason they didn't have Ubers on this island. I forget which island it was.
Of course. Yeah. They were trying to hold back the change.
Yeah. A bunch of cities were like that. And you had to do this old system. They literally had a taxi stand where these pegs were in like different board. It looks so antiquated. It'd been there at least like 50 years. And it blew my mind at that point because I'd seen the light and it was just funny to see. Now you are in the quote unquote land of unicorns. In fact, I'm going to a conference in Seattle in September that Entrepreneurs Organization is putting on, and they're literally calling it the land of unicorns. That's the name of the conference.
Nice.
You've invested in a number of different unicorns. Yep. Looking back, if you look back on the unicorns you've invested in, like you did on those 200 investments you'd made, first, can you unpack a couple of them that you made? And are there any commonalities? Is there something that you saw that led to them reaching this, hallowed $1 billion valuation?
Well, first of all, I'm only talking about four companies that made unicorn in the last 3 years that are on the thesis that I'm investing in my new fund. I've invested in more companies that were unicorns, but not, hardware companies or fuel companies or something else that I'm not going to do. But basically, every unicorn that I've invested in was doing what I was talking about, which is reducing friction at scale in some particular market. And preferably if they have a platform. And usually they're competing against some traditional way of doing things that is just outdated and those people can't move fast enough. So one of them was Jeeves, which is a credit card company in Latin America. They're basically doing kind of the Brex of Latin America. And the reason why I think Brex was one of the fastest companies to unicorn ever. But the reason, what they did is they looked at credit cards, and I experienced this problem personally in America as a CEO, when the credit card companies were all underwriting the personal credit for a company credit card. So if you're the CEO, you have to sign a personal guarantee for the credit card, and your credit balance is only related to your personal income. So what ended up happening is it was really hard to get a big credit balance to run a company on, and you couldn't use any of the company's finances. And what Brex said is, well, that's stupid. Let's underwrite the company instead of the individual. So they changed the underwriting criteria. And that's what Jeeves did for Latin America. They said, we're going to underwrite the business, not the individual. And that was something that was very hard for existing credit card companies to do, to change their underwriting model. And in fact, most of them still haven't. But what they did is they increased access. Gets back to DocuSign, right? There were a whole category of people and companies that wanted access to credit that could not get it given the old underwriting model. And so what Jeeves was, I think, one of the fastest growing or the fastest growing credit card company in Latin America ever, because they basically started issuing credit cards to all these companies that could never get them before. Another company that I invest in, and I saw that in the beginning, and the CEO was an amazing guy too. You always in pre-seed have to have a really on point, amazing person to back.
Yeah. And another piece about that happens a lot is you see a model that works really well, maybe in the United States or in a different market. And then people just kind of, rip off and duplicate and put it in another market.
There was some of that when I was investing in Jeeves in Latin America, because Brex had already proven the model in America. And then you're doing it in a geographic thing. Then the second one was a company called Deal, which is basically an employer of record internationally. And there were others in the US that tried to do that. But if you looked at all the traditional employers of record like TriNet and Paycheck Corporation, they had written their software like in the 80s. It was like archaic, shitty software that in the customer service, anytime you find an industry with a really low customer service rating, you can find an interesting opportunity.
Huge opportunity, yeah.
So they said, we're going to write on modern software. We're going to have mobile first. We're going to make it super easy onboarding, change the UI, blah, blah, blah. And they just crushed it, especially also where a lot of people were looking for outsourced people, American companies hiring developers in Pakistan or Vietnam and wanting more access to international employees from a US-based company. They really capitalized on that, hiring the best person anywhere in the world and making it easy to do. It was hard to do prior to Deal because you had to, if you were a company, set up a whole bunch of stuff to hire somebody in freaking Pakistan. And now you can just have Deal hire them for you. And that person can be working, within one day, which was frankly never possible. Again, they increased the opportunity, the supply of these kind of employees to companies in America in a way that simply did not exist before their platform did.
Yeah. Now, I think you're on second or third fund for Incisive Ventures.
I'm on the second fund.
Okay.
The first fund was a $2.5 million fund I did on AngelList. My current fund is a $10 million pre-seed fund. I just invest pre-seed, $150,000 to $500,000. First institutional check. I define pre-seed as having an MVP in the market. So if you just have an idea and you're trying to write the MVP, I want you to get money to do that from angels or individuals. And most institutional investors are going to want to see until you engage with some customers a little bit. So that's what I'm doing. Pre-seed investing.
And for those, any companies that are listening to this that are interested in knowing more, what exactly are you looking for right now?
Again, the same thing, companies that are, trying to basically with software automate, something that's hard to do without the software. I tend to look at a lot of vertical market software in old industries. For example, Deal, the employer of record industry was an old industry that had old technology. So I see a lot of interesting opportunities in industries that are under IT'd, or even industries that were early adopters of technology that have not changed for a long time, like healthcare, like fintech, like insurance, right?
Yeah. And these are big problems. So I'm imagining this, since you're obviously just one guy, one fund, $10 million is a lot of money by any, measure, but, we're talking about these are industries that are probably going to require 100 million, 200 million to make a big dent in the problem.
Well, absolutely. But that's why, I'm personally an LP in 17 funds, and I know 300 GPs. I've raised over $500 million myself. So I know a bunch of people in the later stages. And frankly, that's why a lot of entrepreneurs come to me or take their first check from me, is that I have a network to get them the next check. And, in pre-seed, you're almost never creating a profitable company. You almost always have to raise more money. So one thing entrepreneurs should consider instead of just taking money from their friends or whoever the fuck they know, am I taking money from somebody who can help me get that next? Let's say, assume I hit all my KPIs. Like, do they know Andreessen Horowitz or Index or NEA, some of these bigger funds that can write the bigger checks when we need to really start growing? And in my portfolio, in a standard pre-seed funded company, approximately only 30% of them receive seed or Series A financing. 70% of pre-seed companies fail because they don't achieve follow-on financing. In my portfolio, 74% of the investments I've made have received follow-on financing. That's 2.5 times better. And so I think that if you are a pre-seed type company, you want to get investors on your cap table that have a proven record of helping their companies raise more money.
Yeah. What do you say to founders who say that it's raising money has become a full-time job in today's market? What's your perspective on it compared to when you were raising money in the 90s and today?
It's always been hard. And if you don't want to do anything hard, you should go to work for Microsoft.
Which you did.
Which I did.
Yeah.
You should go to work for somebody else. I mean, that's the job.
Yep.
I really, go do something else if you don't want to do that. Now, the other advice that I give, and I'm finding more CEOs taking it, prior to Q3 of last year, when money was free, CEOs could pretty reliably be able to raise every 6 months. I mean, it was easy. It was an order of magnitude easier to raise money
than 25 years ago.
Then 25 years ago, even. Yeah. I mean, the last sort of 5 years was amazingly easy. I mean, if you look, I don't know what the numbers are, but 20 years ago when I was raising money, I mean, there were 3 VCs in Seattle. And now there's 25, right? I mean, there is an order of magnitude more money out there. But it is, what I tell CEOs is, I want you to don't do these hand-to-mouth fundraisings, despite the fact that maybe you can every month meet somebody and get $100,000, $200,000 and just sort of, rolling, close, raise the money. Then you are definitely raising money all the time. I encourage people to go back to what has traditionally, 20 years ago, that's not how people raised money. They raised money in rounds. Like when we gave DocuSign their first check, we gave them $4 million all at once so that they had 2 years where they could just build the product and not worry about financing, right? And I think that we're going back into an environment where VCs would rather do that because you're participating in a fully funded round, and companies would rather do that because they have, a break between financings.
Yeah.
If you're always financing, it can be a problem for product development.
Yeah. Martin, I'm a big fan of gratitude, especially expressing gratitude to those who helped you along the way, especially peers and contemporaries, others in your industry, which could be other VCs, could be other investors, could be other founders. But, if you had to do that, if you had to give a shout out to a couple of people who've helped you along the way in your journey, who would you want to mention?
Sure. And I love the concept of gratitude. Actually, at every night at dinner with my family, rather than talking about, TV or sports or anything like that, we do a gratitude practice. We make everybody go around and say what they're grateful for the day. I'm a huge fan of gratitude. As far as related to my career, there's 2 people that I'm very grateful for, and I think that really shaped, how I think about investing in entrepreneurship. And the first one was Ron Conway, who started Silicon Valley Angels. He was one of the original sort of angel funds in Silicon Valley. I was a limited partner in his first fund, and they invested in Google, gave me some Google shares at the IPO, some of which I still own. My cost basis is like 50 cents on Google. And that's been a really life lesson, not just because Ron's a very top-notch quality guy and helped people. He always answers his email, always answers his text. Even 25 years later, he'll answer a text from me. And, seeing how he was gracious with his time and also incredibly helpful to his portfolio companies, people like Google, has given me a really interesting model to try to aspire for as a venture capitalist. The second guy is the first guy to ever write a check, a big check for me. And that's this guy named Stuart Ellman, who's the managing director of RRE Ventures. And he gave me the first big round at Loudeye Technologies. And it was kind of the weirdest pitch meeting I ever said. He goes, I don't want to see a deck. I just want you to tell me about yourself and what motivates you. And so we spent a lot more time talking about ourselves personally, and we've become very good personal friends. I'm actually going to France with him to ride our bikes around the Pyrenees. Our kids are born within 2 weeks of each other. And he's become a lifelong friend. And that's frankly what, it should be in between venture capitalists and entrepreneur. You're creating at least a 10-year partnership. In this case, it's been over a 25-year partnership. And hopefully you really get along with these people, because that's what it should be, is a true friendship, as opposed to here's some money, I'll see you at the board meeting.
Those are great lessons, Martin. Thank you so much for your time here today. Where can people go to learn more about you and learn more about Incisive Ventures? I know you're very active on Twitter, which is how I first learned of your work. But where can people go to learn more about you?
Yeah, follow me on Twitter, Martin G. Tobias, or go to my website, incisive.vc, and love to hear from you and hear what you're building.
Excellent. Thanks so much, Martin.
Thank you.
Thanks for listening to the Smart Business Revolution podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.